Our next story is from India, where on Wednesday, the rupee fell to a fresh record low of over 90 per dollar. As delays in concluding the crucial trade deal with America continue to dent sentiments in a way, the rupee weakened as much as 0.5% to the symbolic new low, and that pessimism also spilling over into the equity market, with the benchmark NSE Nifty 50 index declining as much as 0.5%. Remember, India is still among the few major economies yet to seal the deal with the US, even though officials are optimistic about that happening soon. But the 50% tariffs imposed on Indian goods by the Trump administration, partly as punitive measures for continued purchase of Russian oil, have weighed on the exporters, while strong imports have kept the dollar demand high, adding pressure on the rupee. So basically, a combination of these factors created a supply-demand imbalance in the foreign exchange market, leading to the depreciation pressures on the Indian currency. And as per analysts, the Reserve Bank of India has defended the rupee through aggressive dollar sales to support key levels, but also appears of late to be allowing greater currency flexibility. And with inflation running well below expectations, the RBI's priority basically has been focused on supporting growth rather than expending the reserves to hold an artificial line. So that means that India's central bank was intervening only to ease the volatility, not to reverse a trend driven by the fundamentals. To be clear, analysts expect the rupee to settle in a 88 to 92 range. Indeed, this year's weakness of the rupee has been driven by higher US tariffs on Indian exports and the exodus of foreign investors from the local stock market as a result. But possible improvements in US-India trade ties and a lower tariff rate could also ease pressure on the currency. But if that doesn't eventuate, the RBI may be forced to support the rupee further. What exactly is the real-world impact of all of this? Yes, a weaker rupee makes Indian goods and services cheaper abroad, boosting export competitiveness. This also helps to offset the tariff pressures facing exporters as India seeks to expand its markets by signing trade deals with countries like the UK. And there is a silver lining. India is the world's largest recipient of remittances, remember, with a record $137 billion flowing into the country in 2024, according to the World Bank. A softer currency basically means every dollar remitted buys more rupees, lifting the household incomes and the consumption. In 2024, India received $137 to $138 billion in remittances. That's more than double any other country. In fact, for rural and low-income families, this extra money is the real uplift, sometimes funding education, healthcare, or property investments. On the flip side, a weaker rupee makes imports more expensive, pushing up the cost of essential items like oil, fertilizers, electronics, most of which India buys from overseas. And the rupee's fall past 90 is more than a number as such. It's a marker of a new phase in India's economic story. It also shows that in letting the rupee float, India's policy makers are betting on long-term gains over short-term defense. To stay up to speed with the latest news, download the WION app and subscribe to our YouTube channel.